Banks, they're a little weaker today after their recent run, so we're keeping our eyes on the broader market as well. Goldman's down about 2%. It does take us to our talk of the tape, the future of this rally, whether all of those bulls are too exuberant right now. Let's welcome in our panel, CNBC contributor, Fundtrat's Tom Lee, Solis's Dan Greenhouse. We're all here at Post 9, as you can clearly see. Tom, it's good to have you. I'll start with you first. You say we could go 7,900 to 8,000 this month alone. So this momentum's going to continue.
Yeah, I think the deleveraging that happened a couple of weeks ago put a lot of cash on the sidelines, got sentiment quite bearish, and then on top of people getting very skeptical of the Fed, got markets to de-risk. And now I think as earnings have been good, and I think there's a rethink of how inflation might be cooler than expected, and of course AI is still strong, there's going to be a chase. I think that chase takes us towards 7,900, 8,000.
Most people who are putting out bullish notes cite both of the facts that you did. This major deleveraging process, which was a reset for the market. There was no real fundamental change in anything. It was just there was some froth that needed to be worked out. There was some leverage that got a little bit too high, and all of that needed to be worked out. And then the backbone of the whole thing, the earnings. John Waldron of Goldman was talking about that just yesterday morning.
Yeah, that's exactly right. I mean, earnings this quarter is coming in more than $15 ahead of what people expected at the start of the quarter. But what's really more impressive is 2027 earnings are up now $8. So we're probably close to $4.10 for 2027 earnings. And we're only 3 weeks into earnings season. I actually think it might settle out closer to $4.25 by the time earnings season's over.
Does it sound reasonable to you? And it's not just Tom, obviously. It's, I've been hearing more 8,000 calls sort of, day by day with Ed Yardeni saying his 8,250 could be conservative for the very reason that Tom just suggested. Earnings are just really good.
Yeah, I mean, as we're seeing on the screen, the S&P is already at 7,700, so 8,000. No disrespect. I mean, it's not a huge lift percentage-wise.
I think the implication, though, is like that's just the next stop in this train.
Yeah, I mean, because the thing with the earnings is even if you X out technology and you subtract, say, 10 percentage points off the gross number, earnings are still good. And when you listen to, as many of us do, any number of companies in any number of industries,
almost all of them.
Yeah, the AI story is going well from Eaton and 3M and those adjacent companies. You look at the charts of the KRE, the BKX, the financials are at highs, the KIE, the insurance companies are at highs. The commentary across the board from the card companies who I mention every quarter about consumer spending just fine. So you have all the investment themes going on, AI, power generation, et cetera, et cetera. The consumer's doing fine. Jobless claims 2 weeks in a row, sub 200. For viewers out there who are not aware, under 200,000 in jobless claims didn't happen one time from 2000 through basically through COVID. These are exceedingly incredible numbers. And so just when you take a step back from one being bullish or bearish, the backdrop is positive. Now, the valuation argument is something we can have. You look at SanDisk and some of the moves in those names, obviously South Korea, but the fundamental backdrop is still very positive.